Okay, welcome everybody. We still have people joining, but we're going to get started here in the interest of people's time. Welcome to today's pension risk transfer webinar hosted by PBI. We at PBI thought this would be a relevant webinar topic for three reasons. Pension risk transfers involve pensions and insurers, two key groups of PBI partners. Number two, population management. Identifying decedents and having updated personally identifiable information, key areas of focus for PBI, come into play with regard to pricing and regulatory approval of pension risk transfers. And thirdly, this continues to be an active area with a lot of interest and a record Q1 for both buyout and buy-in activity. So with that, let's start today's webinar. Thanks to our partners on this webinar, Aon, Bolton, and BCG. We'll kick this off by introducing each of the panelists, and then we'll jump into some questions that we have. So why don't we go ahead? I'll start by introducing myself. So I'm John Bikus, president of PBI. I've been with PBI for about 5 years. Prior to PBI, I helped start a company called Legacy.com, which is the online leader in obituaries across the world. At PBI, I've been responsible for strategy, sales, and marketing, building the organization to where it is today. And I appreciate everyone's time and being able to talk to you about key topics like this. With that said, I'll turn it over to Allison to introduce herself.
Thanks, John. I'm Allison Logan. I'm a partner here at Aon and also the Dallas retirement practice leader for our market. I've been in the industry for about 15 years. I'm an actuary by background, so supporting our clients, doing actuarial evaluations, monitoring their plans, and finding ways to manage risk for their pension plan. Which leads me to my secondary role, which is one of the annuity experts on our pension settlements team here at Aon. So helping plan sponsors work through the execution of annuity purchases. And then also I have a role in advising the independent fiduciaries that might be hired for some of the larger transactions. So I'm happy to be here, and I think I'm passing it over to David.
Hi, everybody. My name is David Geloran. I'm a senior consultant at BCG Pension Risk Consultants. I've been in the defined benefit industry for a little over 31 years. I'm not an actuary. I did start off trying to be one, and I was reformed. They got me into a wonderful program where they were able to cure me. But I am involved with all aspects of BCG marketing and sales activity, as well as client service. I handle our fulfillment services. Any client that engages us to run lump sum windows or participant communications, I handle all of that. And I'm happy to be here. Thank you very much. So with that, I'll turn it over to Ellen.
Hey, good afternoon, everyone. I'm Ellen Kleinstuber. I am a principal and the chief actuary at Bolton. And this year marks my 30th anniversary in the actuarial profession. I spent my entire career working with defined benefit plans on the design, valuation, administration, primarily in the single employer and not-for-profit space, but I've also got some experience working with multi-employer and governmental pensions as well. And I spent a lot of my time actively engaged with representatives at the different regulatory agencies through various volunteer roles that I have within the actuarial profession. So it helps give me a perspective on some of their issues and concerns on a lot of the topics that we're going to be talking about during our program today. Over the last few years, I've worked on probably about a half dozen planned terminations and lump sum window programs with different forms of pension de-risking, as well as done studies for a variety of plan sponsors looking at what their right path to pension de-risking is. And I think I was trying to think about this, I did my first plan termination, I think it was about 28 years ago. So it's been interesting to see how the market dynamics have changed since then, and it makes some of the conversations we'll have today very interesting. So I'm really excited to be part of the panel today with this group. With that, I am going to turn it back over so we can get into the meat of the program.
All right, I'm the last one. My name is Mike Irey. I'm the Director of Operations here at PBI. I've been in this role for almost 3 years now. Before then, I spent 7 years at our holdings company, and I have about 15 years plus in longevity experience. With the role in operations, I have a heavy focus on data correction and how it relates to helping us find pensioners or helping us mark them if they've passed away. So I'm excited to join this panel, learn more about how our efforts impact the pension risk transfer space. So, John.
Great. Yep. So thank you all. We have a great panel for you today. So why don't we jump in and get started? This first question is a two-parter. And Ellen, why don't we start with you, and David, feel free to jump in. Why is now a good time to consider a pension risk transfer? And what indicators or variables should a plan sponsor be taking into consideration? Ellen, we'll go to you first.
Sure, thank you. Yeah, I think for some plan sponsors, this is a great time to be considering a pension risk transfer transaction. We have rising inflation. The Fed's been taking measures to increase interest rates, so the purchase prices for group annuity insurance products have declined significantly over the last year. So we have a plan sponsor that has already taken actions to de-risk their investment portfolio. They're likely to find, I think, that their funded status has either stayed the same or it might have improved, depending on exactly how they implemented that investment strategy and the degree of interest rate hedging that they've employed with it. When you have high inflation, the PBGC premiums are going to go up. That's both the flat rate headcount premiums, and we may even see those that are tied to unfunded liabilities going up for some plan sponsors. We'll see the unfunded liability going down, depending on when you're measuring it. June 30th plan year end plans are hurting a little bit this year, but that variable premium rate is going to go up as well. And then those who are at the cap will see that go up. So you're across the board, I think you'll see PBGC premiums going up. That's always an incentive for plan sponsors to think about how do they transfer some risk out of the plan. Now, to be fair, I think there are some other plan sponsors who may find that they're sort of behind the gun in preparing for pension risk transfer, and might find that this is a little bit of a challenging time for them. Again, if plan sponsors hadn't taken the steps ahead to look at how their investments are allocated and try to match that better to how their liabilities are going to change with interest rates, we have this double whammy in the markets right now, where interest rates being up is good for the liability side, but it also brings asset values down at a time where we're coming off of the worst half year in the equity markets that we've seen since the 1970s. So you do have some plan sponsors who took some hits on their assets. Those who have capital available or are willing to go out and borrow may find that this is a time where they say, you know what, I've been beat up enough and I'm done and I want to get out, and they can afford to fund the plan up despite any market losses that they might have incurred, just to get off the roller coaster and stop paying some of the ongoing plan administrative expenses that are likely to keep going up. And then another factor that I think we're seeing with some of what's going on in the labor market, we're seeing a lot of people changing jobs. And if you have a plan that's been frozen for a long time, you may have people retiring or moving on to other jobs, and you're losing some of the institutional knowledge that are related to that defined benefit plan, or just having trouble finding people that have experience working with defined benefit plans in general, even if they could come into your organization and learn your plan. So all this workforce mobility and retirements can take personnel with the knowledge that you need from inside your organization out of the workforce. It makes ongoing plan administration more challenging, and it might be a reason to say, you know what, let's look at de-risking or moving some of the liability out of the plan earlier on. So I think it's a good time, and I think there's a lot of good indicators for that. I think David also has some thoughts on this, so I'll hand things off to him next.
Thanks, Ellen. I think you hit on a key factor, which is that some clients are going to find this a good time and others are not. And in my mind, what it boils down to is success by chance or success by design. Some plan sponsors have really set themselves up for this exact situation and are taking advantage of what interest rates are doing, as an example. But really, any time is a good time for PRT, depending on each plan sponsor's unique circumstances. We've seen some plan sponsors very early in this year, for whatever reason, move fully to cash, which is normally not a good thing to do during, during the market cycle and everything that's going on. But this year has turned out to be a wonderful strategy for them. And they found that they've actually been overfunded and were able to terminate. So, I think the key is really, you jump in this market and it's been very volatile over the past few years because of so many factors kind of coming to a head and really getting stuck in that low interest rate environment. The key really is being able to adapt quickly, understand what PRT is, understand all of the things that you need to do to get ready to interact in the market, whether it's a lump sum window or whether it's an annuity placement, and be in a position to know when the right time is to move and take advantage of the right opportunity for each plan sponsor, because their circumstances are all going to be different.
Great. Thanks, David and Ellen. And by the way, we're covering a lot, I think, in these answers. And so if you do have additional questions, feel free to type those in. And if we don't get to them on this webinar, we'll be happy to follow up with you. Before we go to the second question, just to get a gauge on where we are with regard to this topic, we have a poll question. And so for those of you that are considering or responsible for pensions, the first question is, are you or a client of yours considering a pension risk transfer at this time? If you answer yes or no, we'll give it about 20 seconds. It's a fairly straightforward question. So we'll get about 20 seconds to get some responses here. All right. 63. So 63% said of the participants said yes to the people that answered. So that's a pretty high percentage at this point. So let's jump into our second question then. And this one is for once again a two-parter. Allison, why don't we start with you, and then David, feel free to jump in again. It's around pricing. What predictions do you have around pricing? And how does that impact the decision to do a planned termination, a lift out, or a full pension risk transfer? Allison, why don't we go to you first?
Yeah, thanks, John. So I think as we think about pricing in the market right now, there's a couple different considerations. As Ellen mentioned, the rates have continued to increase throughout the year, so that's going to bring down the ultimate purchase price for a pension risk transfer. Obviously, it depends, as Ellen mentioned, on how you're invested, on whether that's good news or bad news, because your assets have likely declined as well. But overall, as we think about the market right now, one thing that is driving competitive pricing is the number of insurers in the marketplace. We've seen that number continue to tick up year after year. And right now we have 18 insurers in the marketplace that can handle these types of transactions. And a couple of years ago, that number was not as big as it is now. So that's creating a really nice competitive market. And we kind of look at the market in different segments. There are insurers that really only bid on retiree-only transactions. So think of those as lift outs. There are some that feel like they can be really competitive with plan terminations, and so they will only bid on those. And then we also see the insurers kind of divvy up the market as far as size. So, some insurers only play in the small space, where some insurers play in the jumbo space. So having this, broad range of insurers, the diversity of the insurers is really creating this perfect landscape for some good pricing. And so if we break it down into those two chunks, thinking about the retiree pricing, those are pretty straightforward for insurers. Really, all they're betting against, in most cases, is life expectancy. And so those tend to be more plain vanilla. Those are easier for insurers to take on and less risky. And so insurers tend to price those types of transactions more favorable. And we track these from within Aon. We track our transactions to see how they closed compared to maybe the GAAP obligation that you're holding on your books. And in the deals that we saw in the last 2 years, we're seeing about 2/3 of the deals closing below that GAAP obligation that you have on your books. And so that's a win for the majority of plan sponsors here. A couple of years ago, even, we used to think of these as coming at a cost. And now we're seeing that actually we can get these off our books with some savings in addition to the PVC premium savings. So that's one component. And then as we think about, for planned terminations, when we're also including the deferred lives, those are a little bit more risky for the insurers. You have to price things like, when are they going to retire and how much early retirement subsidy are they going to get? Is there a lump sum option within the plan? And the interest rates are variable, so we don't know how big that lump sum could get in the future. Those things, and then also there's longer life expectancy for those younger lives. And so those make the deferreds a little bit more risky. But again, because of the diverse market and the insurers that are willing to bid, we're still seeing some of those transactions be incredibly favorable for plan sponsors, and you don't have to have as much assets as we might have once thought. So, David, I don't know if you have anything else to add to that.
Yeah, thank you very much, Allison. I would add what we've seen is this marketplace of carriers has become very, it's mature and stabilized. And as a result of that, competition is also one of the key factors in pricing for a placement. The carriers are always going to balance their goal of maximizing their revenue and their profit with being sellable, right? They are now competing. It's not just a known, I guess, assume that they're going to get whatever pricing they want. It's become very competitive. And the changes do surprise us sometimes. We've seen one of the carriers, maybe two of them that recently entered the market, has expressed interest in term vested only opportunities, which opens up opportunities for looking at slicing and dicing placements to find the most cost-effective pricing, and maybe going to two carriers. But more importantly, we're seeing the carriers change the way they do things, and it's because of competition and business practices. It's a business and it's dynamic. It's going to keep changing, and that goes back to my earlier point of getting in and understanding the PRT market, understanding what's driving price, knowing when things change, and being ready to jump on favorable pricing when it presents itself is really the key to taking advantage of it, because things do change very quickly. Like you said, we've seen pricing coming in at under GAAP, which was certainly something very strong early on in COVID when they were worried that they would get enough sales. That's not necessarily the case right now. I think we've seen it creeping up a little bit. So you have to take advantage of these opportunities when they present themselves.
So let's transition from pricing to another variable that has an impact on PRT, and it's a variable that's had an impact on everything in life for the past 2 years, COVID. Right. So Allison, why don't we start with you, and then Ellen, feel free to jump in. COVID's had a big impact on everything, including PRT. So can you talk to the impact over the past 2 years and what you see for the future as a result of COVID? And Allison, why don't we start with you on that one?
Okay. So what's interesting, if you look at, kind of a chart of the activity that we've seen over the last 10 years, you've seen a steady incline in both the number of transactions as well as the amount of premiums settled in a given year. And for the first time ever in 2020, we saw that number go down from the prior year. And that really was just plan sponsors kind of pulling back. Many plan sponsors had started a plan termination process, but then decided to pump the brakes on actually paying out the benefits. We saw plan sponsors hesitant to do retiree lift outs, just with the uncertainty in the market and not knowing how the insurers were going to be pricing this and where the assets were going to fall. And so we really did see kind of a pause button be hit in 2020, but then that turned right back around. And in 2021, we had the biggest year since 2012. And so a lot of plan sponsors came back into the market. They were ready to terminate their plans, ready to do these de-risking strategies and doing lift outs. And we really do expect that trend to continue. So I do think it did have us kind of take a step back and reevaluate, but the general consensus was that these transactions are beneficial, and so we should be getting back into the marketplace. So that's one aspect of it. And then the other aspect of it is obviously still mortality. It's a common question that we're continuing to engage with the insurers on right now. how are they reflecting COVID in their longevity expectations? And the answer is still to be determined. They're still studying it. They're still trying to figure out how that's going to have a long-term impact. And they are the experts, right? They are the life insurance companies that are modeling mortality day in and day out. And so they're still trying to figure out how this really impacts us from a long term. So I think from that perspective, for some of the transactions where we are, that are larger, where they're asking for mortality experience for our plans, they're asking us to, typically we would provide 5 to 7 years of history, but they're actually asking for more now because we kind of want to look at what it was before COVID. They're still wanting that 5 to 7 years before COVID because they don't necessarily want to muddy the waters with what might have happened last year or the year before. So that's still an evolving conversation that I think the insurers are going to continue to muddle over, and we'll keep hearing feedback from them as they eventually reflect it. And Ellen, do you have more to add there?
Yeah, it's I think one of the sort of the natural questions that might come up is, well, if the insurers are still mulling over this, maybe should I wait to see if they're going to start to reduce their longevity expectations? And I think they're going to be very reluctant to make certainly any kind of big changes that would affect pricing, because when they're going through this, those of us who are doing valuation work, plan sponsors, you get your actuary to do a new valuation every year. We get to take another bite at that apple each time. Insurers get one shot to make their very best, highly educated guess at what life expectancies are going to be. And they look at a variety of different factors. They look at geography and industry and income level and education, the type of work that's being done, and a variety of other socioeconomic factors. Gender and retiree health status are also considered when we're doing annuity pricing. And going into COVID, there was a lot of socioeconomic disparity in life expectancy of the U.S. population, with roughly a 3-year difference between the highest and lowest decile in the U.S. population. And of course, as we've all been reading the headlines and watching what's been going on nationally with COVID for the last couple of years, we know that there's been some significant differences in the deaths per capita in the U.S. over different geographic regions. There's been some significant discrepancies in the percentage of COVID deaths among different age groups and ethnicities. So insurers are going to be very careful, I think, about reflecting any kind of decrease, because they don't have the chance to go back and reassess the liability and the price that they charge for a PRT transaction if they were wrong. So people ask me, being an actuary, they ask, what do you think is going to happen with life expectancies? And I tell them, well, it's going to be one of 3 things. COVID is going to shorten them, it's going to lengthen them, or it's going to have not a whole lot of effect at all. And I think the answer is going to might be different for different subpopulations. There's arguments for shorter life expectancies as we get new viral strains out. This can be part of it on top of the other seasonal flus that we have. We have a lot of people who delayed preventative screenings and elective treatments during the pandemic. Could lead to impaired long-term health for them, or the strains that we've had on the healthcare system, how quickly that's going to recover. And then the weaker economy can cause people to either to continue to delay treatment or not get treatment because it just becomes unaffordable for them. But then there's also arguments for longer life expectancies, right? Those who have survived COVID arguably have stronger immune systems, may have improved long-term health outcomes as we focus more on our physical and mental health. We get medical innovation coming in. We've shown our ability to go from test stage to release to the public much more quickly when we need to. And there's been a lot of discussion about addressing health inequalities. So I agree, with Allison, right now the insurers aren't making any kind of big moves, and it's not clear when they're going to, but I think we're going to see them probably stay the course on what they've been consuming as far as life expectancies, essentially assuming that this was a blip in the road and we're going to get through it, and then long term, it's probably not going to be much change in their expectations until you start to see some data coming out, some hard data that really causes them to say, we do see that this is going to move the dial one way or another over the long term.
Great. So thanks, Allison and Ellen. So let's transition from, the idea of should we do a PRT? What are the things that impact price? What are the other variables that we should be thinking about, into some of the executional elements, because those are just as important once you've decided to do a pension risk transfer. So David, this question is for you. What are the key steps in a pension risk transfer process?
Yeah, great question. So I think one of the steps that always gets less thought than others is the planning stage, starting with understanding what the objectives of the sponsor are. Oftentimes it's reduced liability for PBGC premium, or we rush to plan termination. But sometimes we see it be a matter of absorbing AOCI in bite-sized pieces. There's going to be settlement accounting. They may be concerned about the hit on their balance sheet. So there are a lot of factors that go into this. The second piece in my mind that always gets kind of a kick down the road is potential compliance issues. Make sure your plan document is fully updated, certainly if you're going into a plan termination. But if you've got a bunch of folks that are past required beginning date, they may be there because you don't know where they are. They could have passed away, and you find yourself in a plan termination situation where you have someone for whom you need to purchase an annuity, but they may be dead. And of course, John, I'm sure that's certainly where PBI comes into play. But you don't really want to wait until you're finding these people during a placement in order to start dealing with it. Making sure you fully understand all of the data that's required for a placement. We see a lot of plan sponsors sometimes wanting to rush into a plan termination, and we start talking to the custodian, and no one really knows where the benefit information is stored. They maybe have start and stop dates, but not the optional forms. It's really just lining these all up and checking off the boxes before you get into any type of PRT can really block those gotcha moments. Understanding the costs. A lot of times we see plan sponsors say, well, we have our MAP liability or PPA liability, and we've applied a percentage to it for a load, and not really understand how insurance carriers look at and price these annuities. They're gonna look at them differently than just applying a liability. They're very conservative in how they price things like fully subsidized benefit. Well, they'll assume everybody will terminate and take the fully subsidized benefit. Is it realistic? No, but it's in their best interest in determining price based on that assumption, so they will. The bid specifications are a huge piece of the pricing. It's really what's going to define the annuity, what structure, everything that needs to be included in there. So it's never a waste of spending a lot of time really diving in and looking at. We sometimes see, obviously, we compete with Aon, we compete with a number of large companies that are active in the space, but we sometimes hear horror stories of a one-hit wonder that doesn't really live in this space and understand how the carriers look at things, get these things wrong, and cost them a lot of headaches downstream. So that's really important. And I think the last piece, in my mind, these steps are more conceptual than check off 1, 2, 3. But I think it's important to remember, going into this, the planned fiduciary has to understand what's going on. They can bring in others to be an independent expert, and they may act as a fiduciary, but it's still a fiduciary process. The goal is for the plan sponsor to really be educated and understand the process and be part of it. And in my mind, that really moves the timeline much sooner into the planning phase. I mean, that's probably where I spend most of my time with my clients, is in the planning phase, because that in my mind is the most important part. And I think later on we have a question about participant communications, which is also a key element. At the end of the day, you don't want to go through all of this activity, save the plan some money, and have some really angry participants because the process wasn't transparent for them.
Great. So to lead that into our next question, which is about participant data, I want to pick up on a couple of key things that David said there. One is planning, right? And planning involves making sure your participant data or information is up to date, right? And also verifying that people in your pension plan aren't deceased and you're paying for them, right, for various reasons. these transactions, you all are more familiar than we are with the amount of money involved, but they're, you know, tens of billions of dollars, right? If not much larger than that in some cases, and they can be held up because participant data is incorrect or invalid for one reason or another, and that's near and dear to PBI, and that's what our next question will get into. But just to give an overview before I turn over to Mike. You know, we work with pensions, insurance companies, and TPAs, and we focus on pensions and identifying decedents through our cert of death process. And we can tell you honestly that 100% of pension plans do not think they are paying decedents, and 100% of pension plans are paying decedents. And we're not talking about 1 or 2 weeks here or there because a cutoff didn't happen due to some process. We're talking about months or even years in some cases, right? So the idea of doing a death audit before and even after acquisition of pension risk transfer is really important here, because we know that there are decedents in pension populations, and cert of death is really the only full service death audit that's going to get you there. And the other thing we have is sort of census, which is proactive population management. So once again, this idea of making sure you have updated personally identifiable information. We can tell you from our experience that, and we've just run through this recently with a very large population, on average, 33% of addresses are not up to date. 33% for people in a pension plan, right? That's a pretty big number. That's one data point. We're not talking about whether or not birthdays are correct, or whether or not names are correct, or, you know, social security numbers are correct, beneficiaries are correct. We're talking about one piece of information, which seems pretty easy to make sure it is maintained based on participant communication, as David mentioned. 33% are on average wrong. And so with that said, Mike, I want to turn, and PBI solutions for that, which we can talk about offline. But with that said, Mike, I want to turn it over to you. Having your participant data accurate and up to date is key for reasons that we've mentioned. What are some best practices for doing that, Mike?
Well, thanks, John. And some best practices here, and kind of what we see is when you give us a file, we'll go out and compare the data you provided to us to the data we see in the data that we're able to get back from our vendors. Some of the points that John mentioned, 33%, that's on a good file. That's when the people think they have good data. That's pretty much on an average file. I've seen it as high as obviously 100% where the clients don't have the location whatsoever, but when it's not so good, it's up into the 70s and 80%. And to David's point, when you want to make sure that a client communication happens, and we're able to handle that and get the communication out to the client, having that address up to date is key. Allowing us to help you, get letters out to these participants to update that is key. And we see that all the time where the addresses aren't up to date. Best practices and regarding names and socials. On a good file, it's going to be about 5 to 10% are going to have the wrong social and the wrong name. Sometimes that's flipping the spouse's information incorrectly there. Sometimes that is just having somebody completely different. We're able to help correct, and if not correct, at least monitor and point out to you where that information is wrong. And then that would help you when you go to that planning phase of this process to see what's going to happen before you get into the annuity phase, or before you start going too far down the path where then you get stuck and have to kind of pause it because you don't have the proper data. And then you go talk about dates of birth. We just had a file last week where a client gave us a couple hundred participants, and one stood out because he was either 66 but we showed him a 64, and they're going to do a required minimum distribution. That's kind of important when it's the required minimum distribution, 65.5. So they have to do some research on their end to see, what was wrong with their data files. So making sure that you have the proper data and up to date is key as early as possible in that planning phase. And that's where we can come in and help you with this data. And what we'll provide to you is feedback on, if that data is correct or not, and where you could be missing, and then help you monitor and find these participants and get them the data that you need to provide to them so they can help with the process. And then to John's point about people passing away, we get a new file in pretty much every single day. And pretty much every single day, we're finding out about deaths that are, a couple of years old and sometimes decades old, really. We'll have feedback from clients. Sometimes they monitor it, sometimes they don't, but I think it really helps clean up their books as far as understanding, what to do going forward with, maybe a pension risk transfer, any other transaction they want to handle. But that's where we can kind of come in, help you clean up your data, find out who's deceased, get updated locations, names, socials, dates of birth, and then you can proceed forward with the next steps in your process. But to David's point, when he talked about planning, he talked about planning with the benefits and the amount of money and that sort of thing. I'm going to a step before that to say, do you have the right name, date of birth, social, and location? Because it's easy to overlook that. And what we see is it gets overlooked, and then there's trouble down the road if you don't look at it early enough.
Good, thanks, Mike. We have one more question or one more thing we want to answer about data. But before we do that, we have another poll question. And the poll question is, when is the last time you performed a death audit? Once again, because of the importance of making sure you have a clean list of participants. And so, the answers are, we are continuously monitoring our participant pool. We performed a death audit within the last year. The last death audit took place over a year ago. We have never performed a death audit. So we'll take 15 seconds here to get these answers in. Good. Okay. So it looks like a lot of people are continuously monitoring a participant pool. Once again, keep in mind, the processes for monitoring that we found can be lacking only because of some of the resources necessary to do that accurately in today's world. We can talk more about that offline and what PBI can offer that's different in the marketplace. But that being said, whether it's a death audit or whether it's updated PII, David, first to you, and then Ellen to you afterwards. How is accurate data helpful throughout the pension risk transfer process?
Yeah, so thanks, John. So the data is going to drive pricing. Much like plan provisions will, like interest rates will, maybe not to the same effect, but they're a key driver. I mean, obviously, you don't want to go do an annuity placement and spend most of your time doing cleanup. The carrier comes back and says, we've done our research on this population. We found all these changes. It can be an annoyance, to say the least. But I'm actually going to put another perspective on this. We look at these pension plans from a macro perspective. Plan sponsor looks at his plan. I have $25 million in liability. They don't think of each individual participant. On a micro level, for each individual participant, it's all about them. No one likes when they receive bad data. Why do you have 525 for my benefit? It's 552. Wrong benefit amounts, wrong dates of birth, wrong addresses. Addresses are a tough one, but all of these things frustrate participants, and we see it time and again when they go through this process, and they get very off-put when they see that their data is wrong. So it gives them a level of confidence that you've cleaned up your data and shown that you have everything in good shape. It makes a much easier transition for the participants.
Okay, and then Ellen, anything to add on that one?
Yeah, I think we've talked a lot about cost of PRT, and so one thing I would say to my clients is if you can't, when you're talking about a PRT, especially if you're talking about a planned termination where the process usually involves trying to offer a lump sum distribution to your active and terminated employees before you go to the annuity purchase part of it, particularly for your terminated employees, if you can't find them, you can't pay them a lump sum. So you take that option to possibly settle the liability at a better price point for the plan sponsor off the table. Now you can still, and insurers won't take missing participants if you know they're missing. You can send them to the PBGC's missing participant program, but for people with larger benefits, that's usually more costly than the lump sum option. Oftentimes it's less expensive than an annuity purchase, but it's still not the most optimal price. And I talk a lot with plan sponsors that I work with about the difference between what I call valuation quality data and plan administration or pension risk transfer quality data. And data and Mike and John have talked about, incorrect dates of birth and incorrect benefit amounts and so on. But there's other things that come into play when we're talking about PRT quality data. So we've talked about beneficiaries. Right? A lot of times I'll ask some plan sponsor like, oh, no, my data is pristine. And then you start asking them questions about their beneficiaries and their joint annuitants, and then you start to get the real story coming out. And Mike touched on this a little bit in his setup. So when you go through that process with the insurers and you've then completed the purchase, they're going to insist on having not just the date of birth and gender, which a lot of people have, the address, which they have, but they also want to know the name. They want their social security number. And that's a lot. That's the kind of data that the actuary doesn't need for doing your annual evaluation, and a lot of plan sponsors either don't capture on their election forms, or they don't store it electronically if they have captured it. So planning ahead and going through this type of data cleanup is important as well. And then where you do have people that are in payment and they have optional payment forms that continue a benefit to a joint annuitant, going through the process of identifying those joint annuitants and looking to see if any of those are deceased is important as well, because that will reduce the amount of the premium paid. Now I think $525 was the example that someone used earlier, is not being paid out over 2 lifetimes. It's going to be paid out just over 1 lifetime for that annuitant. So that can help save cost up front. Now, a lot of times the insurers are good at helping capture some of this on the back end, but I think most plan sponsors would rather pay the lower premium up front by having their data clean and going into the carriers with that than going in with this data and having the carriers come back and give them a refund on the back end. And the carriers may not find all of those deaths. They do have some incentive to do that because they don't want to have to carry the higher liability if they don't need to. But they may not catch it. So the more proactive you can be going into this, the better and the easier the process is going to be, and the more options you have available to keep the cost of the transaction down.
Yeah, great points. Thanks.
And I've got one other thing to add to that. As we think about doing lift out transactions, you may not be ready yet with full complete data like Ellen was talking about for your joint annuitants. We have also seen plan sponsors do something like, we're going to only, if they want to do a lift out, for example, let's only lift out people with single life annuities right now. That's an easy way to get a quick transaction done if you're really trying to capitalize in the market right now, but you don't feel like your data is good enough to go out with anyone with any type of benefit. So you can be selective on your data when you're doing a lift out to figure out which tranches make the most sense. You don't have to feel like you have to have it all clean all at once unless you're doing a plan term. But if you are considering doing a lift out, maybe consider which populations you have the best data for and consider moving forward with that.
Yeah, good point. Thanks, Allison, for that perspective. So let's transfer from data to, we're talking about this as an asset transaction, but there are people's lives affected. There are participants here, right? And so David, to you, what is the role of participant communication in the PRT process?
Yeah, so we talk about these as PRT transactions, but they really are a sum of individual retirement decisions, right? Everybody has to make a decision at some point. They're promised a benefit. They need to understand what their benefit amounts are. In the case of a plan termination, there's a slate of PBGC required communications that can be very technical. If you're just doing a carve out, there's much less communication. But this is people's retirement money. It's as they hear horror stories of failures of financial institutions. 2008 was not that long ago, right? We still have horror stories of what happened in the credit crisis. So people are concerned about this. When we do a lump sum window, for example, as part of a plan termination, we're asking people to very quickly, look at and make a decision that they may have otherwise thought they had 20, 25 years before they even had to think about making. And now all of a sudden, if you catch them off guard, you're like, hey, by the way, you have this really small window to make a financial decision for the rest of your life and bring in your spouse. And, and if you don't, we're going to do this. Like that can be a lot for a participant to quickly kind of assimilate and make a decision on comfortably, and that could affect your take rate. When you go to a carrier, there's going to be an experience. One of the things that we see often in annuity placement, is consideration of an insurance carrier where they provide 401k services. And let's be honest, 401k is a completely different beast. Some of them do it well. Even people that do it well sometimes make mistakes. But during the placement, the last thing you want to do is tell all your participants, you're going to Mass Mutual, and you don't remember, well, wait a minute, we were there 5 years ago with our 401k plan, and it was a horror show, and participants were very frustrated. Now we're going to send your benefits off to them. So you really have to be thinking of the participant perspective as you're going through this. Listen to them, communicate with them, educate them. For almost every single termination we do, we hold education sessions. We actually include them with all of our projects because some plan sponsors don't want to do them, but we always find people want to complete their form on a session because this is their chance to have questions answered. And it's such a great opportunity to hear from your participants and respond to what their concerns are. People concerned about, why can't I choose the carrier from whom my annuity is being purchased? These required notices don't really paint the whole story. They just tell them all of the required information, and it forgets the fact that they may have other questions. Maybe the PBGC, the IRS didn't think of the questions these participants may have. You have to talk to them, you have to listen to them and respond to what they say. It's making them feel comfortable with the process and the decision they're making.
Great. So this is obviously a complex transaction, right? We've only touched on a few elements here, whether it's pricing or data and communication. So given the complexity here, the next question has to do with who should be involved, right? So what internal team members and external partners should be involved? And Ellen, we'll go to you first on that, followed by Allison.
Yep, so I agree. This is truly a team effort, and you need to have all of the key service providers for a client and a plan engaged. So as a plan sponsor, you want to make sure that you have, an actuary who's experienced with pension risk transfer transactions, because this work is different than doing the annual valuation work. You need to make sure you have adequate plan administration support to handle the surge that you're going to have beyond the day-to-day plan management. You're effectively taking, as David said, sort of retirement decisions that people are going to make over the next 25 years and the administration that goes with that and compressing it into a 9 to 24 month period. So that can be internal support, it can be outsourced support. You need to have legal counsel that understands ERISA matters if you don't have an ERISA attorney that you work with normally. Investment advisors that are familiar with the asset liability investment strategies and de-risking strategies. You want to have an annuity placement specialist involved in this because they know the market, they know how to interact with the carriers, are talking with them all the time, and they have those relationships that they can leverage and those insights that they bring to it. Then Allison, I think, had mentioned earlier, having someone who's an independent fiduciary, and you can have that sometimes filled by your annuity placement specialist, or it might be a separate role that you engage someone for, so that there's someone there walking side by side with the plan's fiduciaries and helping them make that decision. I think, as with any team, you need to make sure you have someone who's either the captain or the quarterback to make sure you've got all the plays being called right, that people know what they're supposed to do, when they're supposed to do it, and they're held accountable for it. I like having the actuary in that role, since we sort of naturally interact with all of the different service providers throughout the process, but it can be really anyone on the team or someone internal at the client. And then I've been hearing in sort of more recent years that many of the insurers are also being much more available to act kind of almost as another advisor to the plan sponsor, helping them understand what drives pricing and what factors they're looking at that they're concerned about that can help provide opportunities for either cleanup of data or clarification of what's in the bid package. So I'll hand over to Allison, maybe you can fill in some more about what you're seeing and how the team works together.
Yeah, so typically when we're doing an annuity deal, we're acting as the annuity expert, and so we typically kind of manage the project, and as Ellen mentioned, we pull in all of those various different resources. One other party that I think is good to engage with early on in the process is your trustee and your paying agent, if those are different than your administrators. Those are key as we plan to essentially, we think of it as turning off your benefits from the pension plan and then turning on with the insurers. We want to make sure that those parties are involved, and as well, if you're considering doing an asset in kind transfer where you were going to transfer your bonds as part of the premium directly to an insurer instead of paying in cash. We want to make sure that your trustees are getting involved early. So we've talked quite a bit about who all is involved in the external space, but then there's also, you know, a whole crew that you need to consider from the plan sponsor side. So typically when we do these types of transactions, we're working with the employees within HR. We're working with people in Treasury, internal legal counsel, as well as Ellen mentioned, the external. And then we're also, you know, when we run this process, we're trying to get time with the fiduciary committee. So when we are doing the due diligence on the insurers for these types of transactions, to really do the deep dive and make sure that the committee is ultimately comfortable, we want to meet with the committee pretty often to make sure, number one, we want to educate the committee on the process and their requirements as a fiduciary and how that might be different than their settler role when they're wearing because a lot of these committees wear both a company hat and a fiduciary hat. So we really want to engage and make sure everyone is aware of the differences. And then, you know, we'll meet again to do the due diligence and then once again for final selection. So we really want to make sure that these committees feel comfortable with the decision that they're making. And that's important because, you know, if there is a really truly defined process, then if there is a lawsuit down the road, we want to make sure plan sponsors are protected by the decision that they made. And there's actually a couple different cases. One, when Executive Life failed many years back, there was a company that really truly picked on lowest price. And then there was a company that picked Executive Life based on a very well-defined and documented process. And the insurer that picked on price when Executive Life became insolvent and couldn't pay the benefits, that company that picked on price was found in breach of their fiduciary obligations. And so we think it's a very imperative to have a defined process and be educated in that process to make sure that we are protecting these participants and protecting the committee that's making the decision.
Great, thanks. So our last poll question quickly here will tie into to some of what we just discussed. What obstacles do you currently face in undertaking a PRT transaction? Funding, data, settlement accounting, understanding of the process, and lack of resources are some of the options here. Yeah. Okay, so you can see distributed through, you know, data, funding, understanding the process. Okay, so our last question here, and I'll ask the panelists to synthesize their answers a little bit. We have a couple of follow-up questions that I think would be useful to get into this session and try to get everybody off by the 1 o'clock time period central. So lastly, what pitfalls should a plan sponsor be aware of, and how do they safeguard themselves? Allison, why don't we start with you on that? Allison, if you're on, we can't hear you. So she might have dropped off. Ellen, why don't we go to you quickly on that one?
You know, I think we've talked a lot about the complexity of the process and the different considerations you have to go through. So I think, you know, the best thing that someone can do that wants to go through PRT is to make sure that they have the right team around them. We just sort of talked about this in our last segment. Have guidance, have experienced service providers and advisors who understand the process, who know what the pitfalls are, who know what they're looking out for. Because for most plan sponsors, they're going to go through this process one time and one time only. They don't need to be experienced at, they don't need to know what all the pitfalls are. They need to have the people around them who know what they're watching out for. And make sure that your team of advisors, as you assemble them, are ones that are going to work well together. They're not going to step on each other's toes. They're also not going to drop balls for you.
Great. David, thoughts?
Yeah, I would echo something that Ellen said, which is hiring and engaging the right team. An actuary that's been through a planned termination before. Smaller plans are obviously different than larger plans, but we sometimes see, excuse me, a lot of actuaries when they're helping a plan sponsor terminate say, well, I'll handle the annuity placement process myself. I'll go out to 3 carriers, get a couple quotes, and it'll be good. And it does require an analytic, thorough search to find the right carrier. It's not something that you just go out and get a few quotes for. The actuarial work is very different. Engaging a risk counsel, understanding the determination letter if you're terminating the plan. Do you know what the determination letter is, what it does? Why are you requesting it? I mean, these are questions, people should, if you ask someone, should I file a determination letter? The first response should be, do you understand what the determination letter is and what it does for you? It's not just a knee-jerk reaction to a question that people are paying for, but the unique circumstances. All of the plan sponsors' unique circumstances are different. This isn't a one-size solution fits everybody, and that's why getting the right providers, engaging in discussion, and being heavy in the planning phase are key to success.
Great. Allison?
Can you hear me this time?
We can.
Okay, sorry about that. Yeah, so I think one thing is just to really understand the downstream implications of doing a transaction like this, especially if you're considering a lift out, right? Because you're going to have a plan that's remaining after you do the transaction, and what kind of impact is this going to have on not only your cash contributions, settlement accounting that might incur, the remaining funding percentage that's left for your remaining plan. There's a lot of different items that you want to be aware of for a transaction, and you don't want to just think about this in a vacuum as a single transaction. So really understanding the downstream implications.
Great. And Mike, Irey, any thoughts on pitfalls?
I'll just go back to data again. As we talked about it, one of the things Ellen touched on was the beneficiary side of things. We see that plenty of times where clients come to us, they'll know the participant's deceased, but they won't know if they were ever married. They won't have data on who the spouse was or any other beneficiaries there. So we're also able to help them with that aspect of the process as well.
Great, thank you. So in the interest of time, listen, there's one question I think to close this out might be useful for the panelists to answer quickly here, and then we'll finish up. And it has to do with private equity. So private equity has taken a bigger role in being behind some of the insurance carriers in these purchases, and it seems like Congress and maybe the state treasurers have some concerns with this. Are these concerns warranted? And what's your perspective on this particular question? David, why don't we start with you?
It's interesting. I have a number of clients right now whose plan termination is stalled because of private equity, and they're trying to liquidate it sooner in order to make distributions. I mean, yeah, it's certainly a source of concern. Private equity has restrictions, and if, like I said, if you go into a plan termination process and aren't fully aware of all the moving pieces, you can trip up on this exact type of thing. My one plan sponsor I had a meeting with today, they want to get out by 9:30, and they have to wait till private equity can be liquidated in November, pushes everything to a bad time for placement. Kind of came as a surprise to them. And no one likes surprises if it's not gift wrapped and boxed, and certainly not during a plan termination. So yeah, you be concerned. I don't know that it's at the point of governmental oversight, but it's certainly something to be aware of.
Great. Ellen, any thoughts?
Well, I'm going to actually steal an idea that David and I have talked about a number of times. So with due credit to him, one of the things that can help with identifying these sorts of issues that can come up for a particular plan termination is to take the termination process or the pension risk transfer process through a dry run before you're actually ready to do it, and say, okay, I'm not actually doing it now, but let's kind of walk through each of the steps of the process. And that will help reveal, when you get into dealing with matters of private equity, what the pitfalls are going to be for this particular transaction. Do you have timing with liquidating it? If the plan is actually owned by an entity that is a private equity investor, are you going to have issues with the timing of capital availability to do the final funding? Are they going to want to have hands in it, as well as the day-to-day management of the plan sponsor? So it can come in a number of different ways, and running through this and kind of going through the whole process and looking, right? I always say start with the end in mind. So get to the end of the process. What's going to cause you to trip going over that final hurdle? Let's plan ahead for it. So just looking and really thinking carefully about what the impact of private equity, whether it's an investment in the plan or it's an ownership of the plan sponsor, is going to mean in this process.
Great. And Allison, anything to add?
Yeah, and just in the essence of time, I will quickly say that I agree with both David and Ellen, and I think the more planful you are at the beginning on the front end, the smoother the transaction will be.
Great, thanks. So we are at time. If we didn't get to your questions, we will follow up with the appropriate person getting back to you. Thanks to our panelists. It's greatly appreciated. Your insight and your expertise, greatly appreciated. And thanks to the attendees who have been on. Once again, if you have any questions, feel free to reach out to us directly. We've also published contact information. Feel free to reach out to any panelists with any questions that you might have. But thanks for your attendance. Hopefully this was enlightening, and have a great day.
Thank you, everyone.
Thank you.